So a growth stock is a share of a publicly traded company whose revenue or growth is expected to beat that of the average market. And the characteristics that you would see from a growth stock is they tend to be younger companies, though not always. We can get into some companies that are 15, 20 years old that are still considered growth stocks. As long as they're innovating, as long as they are bringing something to the marketplace that allows them to grow at a multiple, investors tend to pay up for growth stocks. So if you look at their PE ratios, they tend to be a little bit higher. They tend to be a little bit more volatile. And the other characteristic about most growth stocks is they don't pay a dividend. So when a company gets its profits, a growth stock will tend to take those profits and reinvest it back into the company because the management feels that that is the best use of their money, to put it back into the company so it can grow and move forward. And then there gets to be a period of time when maybe the company is not innovating as much. Maybe it's still a relevant company, still has a lot of good things to offer, but those days of growing 20% or more are behind them. And so one of the ways that a publicly traded company can offer value to the shareholders is to provide a form of a dividend. And those dividends are typically, most companies will pay them quarterly. And what a dividend is, it's just a sharing of the revenue. And value stocks tend to be, the reason they're called value is they tend to trade at lower PEs most of the time, although that's not always the case. They tend to pay a dividend. They tend to be more established companies. And these are stocks, especially large cap value, is stocks that we usually fill full of people who are either entering retirement years and they want that growth that equities provide, but maybe they are a little bit adverse to the volatility. We can't stomach the 30, 40% swings that potentially could come from a growth stock.
Yeah, and especially the dividend's nice for passive income too when you're investing in value.
Absolutely.
But going back to dividends with growth, I've even seen it to be the case where like investors, or they'll write articles about investors being mad if a growth stock offers up a dividend because they think more of the resources and profits should be reinvested into the business.
Well, that's kind of a telltale sign. I don't want to say that the company's trajecting downhill, but that could be a sign of a couple things. It could be that the company has more money than it knows what to do with, because sometimes analysts will punish a company if it's got so much cash sitting on the balance sheet that it's just not reinvesting back in the company, and they're wondering, hey, why aren't you doing something like this? Why aren't you developing new products? Why aren't you making purchases, acquisitions? And sometimes to avoid that, they will trickle off a little bit of a dividend to shareholders. And I'm going to get into a couple of companies that maybe are kind of on that borderline where they do trickle a dividend, but it's not anything that you would purchase just for that dividend. It's not enough, but it's nice to get every once in a while, because the nice thing about a stock is you get the potential appreciation of the stock price, but you also get the dividend as well.
Yeah, I have a couple shares of NVIDIA. We'll talk about NVIDIA. And they have like a 44-cent dividend per share. So, yeah, I'm not retiring off that or anything. But I mean,
no, you're not.
Then there's a company like Apple or Microsoft. They have high growth rates. And like you said, they just have a mountain of cash that literally you couldn't figure out what to do with it besides just burning it. So that dividend's a nice way to get rid of some of that cash.